everyone, and welcome to this week's installment of Mish's Market Minute. I am your host, Mish Schneider. Thanks again, StockCharts TV, for giving me this platform to give you different stock books. And today, something a little bit different, an education. An education that I hope will help you in the particularly choppy markets that we're living in right now, but in all market conditions going forward. So this will be a video that you can refer back to again and again and again. And today we're going to discuss risk gauges, because a lot of people look very much at moving averages or relative strength or Gann or Fibonacci or Elliott waves or DeMark, and all of that is great. But all of that sometimes almost is too myopic in terms of what's going on in the overall market, or what I always have, you've heard me say to you over and over and over again, the outliers which often can relate to you that risk is on or risk is off, even if the charts are late to that party. So that's what I want to go over with you today. And I'm going to start with a product that we have in MarketGauge. It's called Big View. And at the end, I'm going to show you how to access it. But essentially, in the Big View world, which is really meant to be a macro top-down type approach to trading, which is something that I do very strongly, there are 5 key intermarket relationships that I look at all the time to determine whether risk is on, risk is off, and by the way, we can even have neutral risk. And it starts by looking a little bit like an odometer here, which is kind of because my husband designed this and he absolutely loves cars. But what you'll see here is very color coded. With the odometer, obviously 100% is full risk on, maybe even running a little rich. If we get into the yellow, that's more risk neutral. And if we get into the red, then it's risk off. Not only do we see what it looks like in the current form, and by the way, this is just a snapshot. This is not what current form looks like. But we also compare it to what it looked like a week ago. So, hey, we're staying bullish for a week, but a month ago, we were really super negative. And all of this gives you an idea of sentiment. Then if we have a risk on environment, obviously that's going to favor equities. And these relationships really will help you decide, especially in a choppy market condition, are we risk on or are we risk off? If we're risk on, obviously equities is where you want to be. If we're risk off, you want to be looking at fixed income, being in cash, or, hey, my favorite topic lately, commodities. So let's look at the key intermarket relationships. And basically, we're going to look at ratios. And you'll see when we get to the charts, the ratios are very much driven by what you all have access to on your charts, which is relative strength and leadership. So we're going to look at the stocks through the S&P, the bonds, the high yield debt, gold, wood, and utilities. Now, when you're talking about utilities, I have an expression, of course, that when Uncle Ute shows up at the door drunk, it's time to pay attention. And what that means is not sloppy drunk, but more celebratory drunk. Like, imagine a man coming to the door where the Modern Family lives with a half-drank bottle of champagne, and he's all happy, but you got to be a little concerned, you who are really representing the sectors of the US economy. And even though I'm not putting up a chart right now for you of XLU, very simply, if you look at it, you could see we're on new all-time highs, while we're pretty far, still about 3 or 4% from new all-time highs in the S&P 500. So you don't need to be an economist to understand these relationships. In fact, I have become sort of a talking head on the macro, which is funny to me because I have no degree in economics. I didn't even study business in school. I've just been a student of these relationships, and they basically tell you everything you need to know. So, as I just mentioned, when we see these utilities show up and go to all-time highs like we've seen, that's actually kind of a risk-off environment. And you can also see here that basically we're just looking back at the past. So when you have the utilities going up and the SPY going down, that's definitely a risk off. Sometimes they don't necessarily work as in tangent like that. So now let's take a look at another relationship. I didn't put up a chart of the SPY versus utilities, but I can tell you right now that utilities, just based on the price action, is leading the SPY. And so that's what's making this so dicey. As people are getting more and more bullish because of the charts, I'm still saying caution prevails here, and you have to pick your spots carefully. And here's another indicator. So this is the SPY versus the interest rates. So when you're on a risk on environment, you want the SPY to outperform the bonds, which is kind of tricky. These are the long bonds, 20+ year bonds. It's kind of tricky, right? Because when we've had so much quantitative easing, we've had periods where the bonds have gone up and the SPY has gone up. But more recently, with hawkish talk by the Fed and the slight raise that they did in the interest rates, and this chart, by the way, is right up to date, you can see that this chart, the TLT chart, has gone down while the SPYs went down. When you have both bonds going down and equities going down, that's really a risk-off situation. But right now, we're having a little bit of a divide again. So when I talk about the real motion indicators, this is just looking strictly at the TLTs, which had a mean reversion trade, by the way. If you're sort of a demarked mean reversion trader, it kind of signaled you here that it was time to maybe buy the TLTs or at least cover any shorts, because then the next day it went through, you would have had a little bit of a, I don't trade these, I just use these for information. But nonetheless, what we're really looking at here is the relationship between the TLTs and the SPY. And what we can see right now is the SPY is still outperforming. So the bonds have gone down, the SPYs have gone down, but the SPYs have recaptured a lot of that move down. And that's why, even though I just showed you utilities kind of more risk off, the relationship between the SPYs and the long bonds still a little bit risk on. So if you could see why things are confusing, this is exactly why. Okay, the other relationship we like to look at is high yield debt versus the long bonds. So what's the difference? So high yield debt is riskier, right? Because the borrowers are more likely to default. Why? Because you're buying basically companies that have a lot of debt. And they may not necessarily have good balance sheets, but in a risk-on environment, you go there because you're also going to get much more a return on your money and higher yield. So that's why in a risk-on environment, people will buy junk bonds. But we want to look at not just the junk bonds in and of themselves, but the relationship to that and the long bonds, because that's also going to give us a good appetite for risk. If investors are willing to take a chance on riskier debt, as I just said, especially as compared to the long bonds, risk on. So let's see what that looks like. So this again is a chart of yesterday. This is the HYD. So this is the municipal index ETF that is high debt bonds, not HYG or junk. I looked at something a little different based on our big view product. Now, what we can see here is the relationship to TLTs. So again, if you have our ACP plugins, all you have to do is change the leadership to the instrument that you want to measure the instrument again. So in this case, I went from SPY to TLT. Obviously, you can see momentum is not all that great in the high debt. But what we're really interested in is how is the high debt looking compared to the TLTs? This, the fact that now high yield debt is underperforming the TLTs, at least as of the close of yesterday, means that we're on a little bit more of a risk off situation. And if you look strictly at the junk bonds, they've come back from the lows, but they need to do a little bit more in order for this relationship to change. So far we have two indicators that show risk off, one indicator that shows risk on. Interesting, right? So let's continue. The next one is how the S&P 500 is doing versus the gold. So gold obviously has been going up because of geopolitical situations. So that's a really good indicator of risk number one. And number two, at the same time, though, it's been a little bit struggling here to go any higher. There's been a lot of physical demand, but not a lot of buying in the actual physical gold. I guess, I don't know, people still think the Fed probably is going to raise rates more. That's where you're getting a risk off. And that's why gold hasn't completely flown at this point. But it is used as an alternative currency, even though we've got cryptocurrency. As I just mentioned, it does go up during geopolitical stress, goes up definitely when we have high inflationary periods, which is why it's up, but it's not necessarily flying as much as many expect. And if gold is outperforming SPY, again, that would be considered risk off, not for commodities, but for equities. However, if gold is outperforming the SPY because of inflationary pressures, you might sometimes see both going up together, which is kind of what we have seen over the last couple of days. Basically, what we're saying in that case is that gold is an outperforming SPY right now. Well, we're going to look at the chart. Because of necessarily inflation, it's because of more geopolitics. Inflation to a healthy point is when you see SPY go up. When we get to a point where it's now starting to affect the bottom line of corporate profits, as we're starting to get into earnings seasons in the next couple of weeks, that's when you can go back to more of a risk off. So let's take a look at a chart. So again, chart up to date, but doesn't matter what point in time you're looking at. You could look at this in 6 months from now. It's always going to be the idea of the relationships. Now, in this case, here's gold. Obviously, you can see in our momentum indicator, it's still doing well. This is the thing we're interested in. We're back comparing gold to SPY. And right now, gold is still underperforming SPY. Isn't that interesting? So this is another vote for risk on. So far now we've got 2 votes or 3 votes risk off, 2 votes risk on, because SPY is still doing better than gold. So gold is the blue and SPY is the red. That's how I can determine that. Okay, let's go on to the next indicator. So we also like to look at wood versus gold. So wood, of course, is another very key commodity. And it tells us not only about the housing market, but obviously it's a key driver of the entire economy. And interestingly enough, the housing market in terms of home builders has gone way down. But in terms of the actual REITs, it's actually held on pretty well. It's actually one of the stronger performing sectors right now. And so that will be interesting for us to see whether or not it is outperforming gold. That could be an indication of inflationary pressure, but it could also mean that you could see it actually underperforming gold right now too, but I don't know. We're going to take a look in a moment. But essentially, all these relationships together. So we just saw utilities risk off, TLT risk on, junk risk off, gold risk on. So let's see where we are in wood. Now, right now, wood, obviously momentum is pretty good. So look at this. I changed this now to GLD as the one that we want to compare it to, and wood is indeed outperforming gold. So it's an inflationary pressure, but it's also a better sign for the economy. So this is a risk on. So again, if we sum up all the different relationships here, basically what we have is risk on. Let's go back to this other slide because of the relationships. Risk off, risk on, risk off, risk on, risk on. So that means we've got actually 3 of the key market relationships showing risk on and 2 risk off. So if some of you are scratching your head saying, gee, I don't know what to do in this market. I don't know where it's going to go. I don't know what's going to sustain. The instruments I'm in are choppy. I've been getting stopped out. Sometimes I get lucky, but lately it's been hard. This is why. But in really good times, all of these intermarket relationships, when they are all flash risk on, that's when you're going to push and buy a lot of equities. And when they all show risk off, that's when you're going to get very cautious, either get out of the market, go to cash, or in case of like geopolitical risk, look at gold, or in case of just out and out inflation, look at energy and gold and food commodities. And this explains to you why those have really well outperformed the market, while the market hasn't actually given it up. And that's where my whole stagflation theory comes from. So to sum up, I want to show you that on our website, which is MarketGauge.com, if you go to this and click this, you will get to our big view product. That gives you all the risk on, risk off indicators. However, if you don't want to make heads or tails of it, we have a weekly market outlook with a video that comes out every Sunday that is written and produced by Keith Schneider, CEO of MarketGauge, and my other half. And so if you go to MarketGauge.com and you go under Market Beat, you will see his outlook. And what this covers is all the risk gauges I just talked about, the internal sentiment, which we didn't really get into, the interest rate style, investing style, and then the sector and worldview. So it's going to give you even more than what we just did. I just really wanted you to understand risk. So now you know, A, if you're watching this recently, you're not nuts if you're confused. B, things could easily switch to a risk-off environment if we start to see some of those other relationships like we talked about that are now risk-on, like SPY versus TLT, wood versus gold, flip the other way, which case get super cautious. Or we can easily see everything flip to risk-on. And then, of course, that would be a reason to believe that whatever the news is and whatever the horrible situations that we've had to endure in terms of the economy, the war, inflation, et cetera, the market is forward thinking and they see that it will abate. And that's why I like to use this as a big macro drop, because it really tells you how much you should be involved in the market at any given time. So I hope this was helpful to you. As I said in the very beginning, I showed you charts that were recent, but with the stock charts and the plugins, you can pretty much look at it at any given time and use this information to make your own determination, because the actual information about assessing whether the gauges are risk on or off are eternal. Thank you so much for watching, and bye for now.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.